Hello everyone, hope you guys are doing great today. In my today's video, we'll go through the con call summary of EFCI Limited after their Q3 FY26 results. But before we get into the numbers, let's look at what the management said about their strategy and what they are planning to do. So the management is very clear, right? Their strategy is to build the company as a estate as a service platform where they provide services from leasing, design and building and furniture manufacturing so that they're able to provide end-to-end services to their client and no one comes in between. Obviously this helps them to improve their margins and at the same time gives them an opportunity to cross sell their products also, and that is what they're trying to achieve. And if you look at their numbers, I think that's what they're achieving also, and they're doing quite well. So if we the revenue increased by almost 52% to 270 crores from last year, and PAT was up by almost 43% to 62 crores. And if you look at the interior division, which grew 76% YOY, and in terms of the leasing business, the occupancy rate stood good at around 90%. And for the furniture business, which they recently acquired to do backward integration, is ramping up quite well. And currently, the capacity utilization stands at around 35 to 40%. And if you look at their PAT for the whole 9 month, which is around 166 crores, is already more than the whole PAT for the last year of FY25, which is a really great sign showing that the business is moving in the right direction and increasing their bottom line. So let's look at their three main divisions and the updates that they given. So in terms of leasing, the management clearly said that their leasing portfolio remains quite diversified between technology, consulting, BFSI, and manufacturing companies, which gives them the stability in revenue. So this is like their main bread and butter from which they earn the revenue and run the other businesses also. And if something happens to them, that might be a problem for them. If you look at their occupancy, the occupancy remained well at around 90%. And there was a question asked that because of the AI changes which are happening and employees getting sacked from their companies, will there be any impact of IT companies not leasing more facilities? So on that, the management said that they don't see any such trend. Even though the AI thing is happening for the past 6 months, the demand is quite strong, and they don't see it slowing in the coming quarters at all. And in terms of the seats added, so their target for this year was to add around 20,000 seats. By Q3, they had already added 13,000 seats, and for the out of the remaining 7,000 seats, 5,000 is already in the pipeline, and the management is confident to achieve the overall number by the end of FY26. If you look at their design and build division, which is the interior division, the management is quite confident of achieving a growth of around 50 to 60% YOY for the next 1 to 2 years, which is quite a good sign. And if you look at the order book for this division, it stands at around 160 crores plus, and the management has said that they will maintain this level of order book going forward also. And let's come to their furniture business, which they recently acquired for to do backward integration. So the capacity utilization is picking up, the efficiency are improving, the margins are improving, and the management said that by the end of second quarter in FY27, the capacity utilization should pick up to around 75 to 80%, and that should contribute well to the overall bottom line. In terms of the margins, the management said because they're into leasing business and the way the accounting works, the best way to look at the margin is look at their PAT margin. So for their leasing business, they will maintain a PAT margin of around 25%, and for the design and build vertical, they will maintain a PAT margin of around 18 to 20%. For the furniture business, they did not give any margin guidance because they said they want that division to achieve proper capacity utilization, and only after that they will give the guidance on this. And in terms of the revenue guidance for FY27, management hasn't confirmed any numbers as of now. So we have to wait for the Q4 results and the con call to see what the guidance management gets. And if we look at the valuation of this company, if you look currently at the market cap and the rate at which it is growing, it's a engine which is growing 30% plus, available at a PE of around only 15, which gives it a peg ratio of around 0.5%. So the deal is quite attractive. But obviously, we have to see and track the business to see whether they are able to continue delivering this growth in the future or not. If you like this video, please do subscribe to my channel. Thank you and God bless you.